My name is Ryan Micheletti. I'm head of global operations for the Founder Institute. I'm a general partner at the Veteran Fund, and I've spent the last decade leading the team that helped us scale to 8,000 portfolio companies across 200 cities, where I built a personal portfolio of 700 startups. Today, I run the Venture Network and the Veteran Fund, which invests in seed stage critical technology companies with elite military veterans on the leadership team. So today we're going to discuss new investment models to maximize returns, and we'd also like to do extensive audience Q&A. So we do have an international audience joining us. Please say hi in the chat. Tell us where you're tuning in from. If at any point during our discussion you have a question you want to ask, just go ahead and put in our chat. Our producer here in the background will send it to me, and we'll try to get to as much audience Q&A as we can. So before we begin, I'd like to give a quick shout out for the FI Venture Network, which is our exclusive network of early stage VCs, angels, and investors from the Founder Institute's global network, including Decile and VC Lab communities. So as an investor member, you get first look access at our companies that are raising capital and exclusive invites to events and opportunities like this and others. So the application takes less than 5 minutes to complete. It's completely free for investors. We just want to build one of the best investor networks in the world. So please go to fi.co/venture to learn more. All right, let's go ahead and get started. So I'm excited to introduce our incredible panel of speakers today. Serhat Pala is the president of NuFund and a GP at Cross Ocean Ventures, and Ashok Kamal is the executive director at NuFund and also an extensive angel investor. So, Serhat, would you mind doing a quick introduction for us?
Sure. Very quickly. First of all, it's great to be here. Especially given the fact that we'll get to talk about a lot more how NuFund Venture Group pioneered the venture group model, and being able to talk about that with another pioneer of their own model group like Founder Institute, I think it's pretty good. I'm looking forward to it. I am, even though I'm on the investor side of things for the last almost 6 years now, I am a founder. Once you're a founder, you're always a founder. So I started my first startup in the very early days of internet in the 90s. And then after that, one after the other, some failures, some, successes that led me to about 6 years ago after my last exit to say, I am ready to put my head and just try to help the other founders make an impact rather than try to be in the steering wheel of things. So it's great to be here.
Yeah, well, thank you for joining us. NuFund certainly has a great reputation, and it's an honor to have you both here. Ashok, why don't you do a quick intro now?
Yeah, thanks, Ryan. Like Sarhat, excited to be here. And, going back decades, I've had multiple interactions with Founders Institute from Boston and New York City, where I was from, to where I'm now located in San Diego in the program here. So it's great to be full circle and to be working with you now and Mike. I am also coming from an entrepreneur's background first. I guess maybe the most interesting, if I look back on the 10 or so companies I've been involved with starting, would be a hip hop record label in the aforementioned New York City. And that's obvious why, which was pre-tech. In fact, we created a little Winamp player when people weren't even listening to music online. But that ultimately was a failure, and it was a bootstrapped company. So at least we could only lose our own money. And then fast forward, maybe 10 plus years later, the maybe most interesting company that I started was in the recycling software space, and that was in the early 2010s. So all of that and more led me into dipping my toe into angel investing. And I think 2015 is when I made my first angel investment. And now I'm a part of NuFund, and we'll talk about how the angel world has converged into the venture group model that we now work on refining and building every day.
Yeah, amazing. It's also interesting to see just how addictive angel investing and just the whole startup scene can be. And so maybe let's start off with just a little bit more context around NuFund and how it's evolved over time. Ashok, I mean, you're the executive director there. So do you want to just chat a little bit about what inspired the formation of NuFund? How has it evolved over time?
Yeah, NuFund existed as a classic angel group for more than 10 years before I personally encountered it. And my discovery was actually through making an angel investment in San Diego, where I had moved for lifestyle reasons. And then shopping the deal around to look for other investors to participate alongside me, finding what was then called Tech Coast Angels San Diego, a sort of classic angel group model here in San Diego and part of a network of other Tech Coast Angel models in Southern California, pitching the company to them, ultimately not getting funded, not having the best experience, not the worst. I've seen, the spectrum, but not getting funded and having the tables turned on me personally as a then investor and helping out kind of as a advisor operator for the company, where the Tech Coast Angels board, because again, that's what it was called, asked me if I'd be interested in coming in as the executive director, the first full-time employee to be hired at this organization. And I thought it would be a great way to, one, learn about angel investing, and two, to build my network in Southern California, since I basically had no network when I moved here from the East Coast. What I discovered, and this led to the changes that we'll talk about, was a very problematic and broken model. And I think any product or company that we all as entrepreneurs want to or should work on has to start with a pain at the neck bleeding problem. And I can say that Tech Coast Angel San Diego and the Angel Group model was unequivocally and unapologetically broken when I got involved in 2016. I would say the classic Angel Group model is often still broken, today, but we wanted to try and fix it. And so what did we focus on? The core problems with the type of angel group that Tech Coast Angels San Diego were both structural, having to herd cats and chase small checks, not having an efficient process for getting to a decision for entrepreneurs. So you have this, and then not having a sort of founder friendly, or what we'd call founder fair culture. So who is going to actually go and raise money from a group that takes forever, is not clear that they're going to even write a check, and might treat you crappy along the way? Clearly an adverse selection bias, which then if you look at the returns, right, of these organizations, they're not going to be great. So that's the broken organism that, it was by no means just me, but the leadership at Tech Coast Angel San Diego wanted to try and fix. And we focused on creating a better model, crafting and obviously refining, which we're still doing over the subsequent years, namely launching our annual fund where we pool capital from the group and deploy it through a voting system among the members. That's one of the core elements of the venture group, but I think we'll talk a little bit more about that.
Yeah, that sounds good. I mean, like on that same thread, Surat, do you want to dive a little deeper into the venture group model? Maybe like an overview, some of the benefits. It sounds really interesting.
So when we talk about the venture group model, we almost have to talk about what it is not first. And I actually want to go back to a little bit also the historical roots, because when Ashok said when he encountered this group, the model was broken, which I somewhat disagree with it, because I think the idea was good, but the model really never worked. And I can, unequivocally say it myself, because interestingly, with my second startup, I did pitch to this very same group as a founder myself. And it was one of the worst experiences that I had. And in fact, I have to say, it made me want to not raise funding because I was up to something. I just started a company, early days of e-commerce, literally using my credit card, $3,000-4,000 on a balance. And I grew that company from zero sales to almost $1 million in less than 6 months, being profitable. And I was pitching this group, my business, and it was a somewhat very early days of the internet. So I even had to explain what internet was to half of the members, and it worked really bad. And at the end, I told myself, you know what? I'm going to be much better spending my time on things that I can control rather than trying to go and pitch things to people that probably do not understand. They want to understand it, but only a few, and then will take forever to write a check. And I could rather increase my sales, which worked out really great for the first couple years until the market, the timing was right. New people, new companies were coming in the market with more capital, more mentorship, more advice, and they were able to come in and do much better. And at the end, I did have somewhat of an exit that gave me a chance to build something bigger and better after that particular exit. But I that was a lesson for me, especially now in my current role, to make sure that other founders will not have similar type of experience. I mean, angel investor concept is a great concept because here you have people that love innovation, that are intellectually curious, that want that would like to help founders, that want to be involved. But then, then the model is so decentralized, democratic to an extent that it's not very workable. That they are not able to deliver. So, so the venture group model, in fact, started from looking at what was right about the angel investor model and what was not good about the angel investor model. And the main difficulty and I think the problem is you put through in an angel investor model, investment decisions are made by individual investors that have all different kinds of experiences, backgrounds, and investment thesis, if they have one. And then you make them go through a very prolonged process. Some of them, and it's not standardized. It can take forever. And at the end, you might not even get one or two check of $25,000, $50,000. So it's a very unknown model. And what the venture group model is at the end of today is about people that want to invest, and they don't have to be angels. I think that's one of the key differences between venture group model and the angel investor group model is in the venture group model, the members they don't have to be angel investors. We have VCs, we have CVC partners, family offices, and so forth. And in fact, I mean, I got exposed to the concept of NuFund when I was a VC and having difficulty with my due diligence process, but we can talk about that later. And what the venture group model is able to do is, with utilizing a venture fund that is funded by membership, we make that venture fund an operating model where we can get organized, but not to an extent where there is a structured bureaucracy, and then use that venture fund for our investment making decisions, due diligence, and at that point be able to put the founders to a more standardized process where there is a potential end result with a meaningful check and support that will come after that decision making.
Yeah, I mean, you cover a lot of really good points there. I mean, like maybe let's dive into the economics of this. So essentially, it sounds like the typical angel model is an individual angel will put capital into a company. And when you have, let's just say, like 50 angels looking at a deal with 50 different bank accounts, it can really slow down that process. What was kind of or what is the thinking around the pooled capital, and how does that actually work? But what are the economics around it, and what have you found to work really well?
Well, we can talk about the economics from both the manager's perspective as well as the entrepreneurs. Let's start with the entrepreneurs because, to our point, if the UX isn't good for entrepreneurs, you're not going to get great, let alone the best entrepreneurs, which is how you then make returns and economics for managers, right? The adverse selection bias cannot exist for any successful fund manager or investor. So the economics for entrepreneurs in a fund or pooled capital model like we have at NuFund, what we call our annual fund, is they can get a check for $250,000 to $500,000 in 30 days or less with a single cap table entry based on a democratic vote of the people who are in that fund. It's a highly structured and rule-based system where the entrepreneur can have transparency into what the steps will be, and they will get an answer, yes or no. Obviously, the answer is usually no, because that's the business of venture capital, and we see a lot more deals than we're able to invest in. But any entrepreneur who's worth their weight understands that. When we say yes pretty quickly, and we say yes pretty potently with a multiple six-figure check. So that's the economics for the entrepreneurs. We can talk about the manager side if you want right now, Ryan, or we can, continue on that
Yeah, I
thread.
mean, I think it's a great innovation in the angel investing space for multiple reasons. I think it does fix a lot of the problems with that, founder experience going through angel groups. And it's frankly even why, well, when we were talking to founders who are going out and fundraising, some of the historical best practices are to avoid going to angel groups simply because of how long it would take to get the capital, how long of a process, and how, cumbersome it is to manage all of that. And so maybe talk a little bit about the economics on just so we understand the fund structure and how it works, how it differs from a typical VC fund versus like the old angel group model. Like how does the venture group model operate internally?
Yeah, and you don't have to look far to see examples who had either bad experiences with angel groups or, mixed experiences, because that's both Sirhat and I. Although I wouldn't say I was treated unfairly, my deal got turned down, which was a miss, by the way, in retrospect, if you follow that deal now, 8 years later. And in Sirhat's case, it was, not only a miss, but also it was not a rewarding experience. So, that's a common, I would say, story arc if you talk to people that have pitched angel groups, for the past 25 years, including who pitched them yesterday, right? Now, when you can flip the script and make the fund, even if it's an angel fund or a venture group, however you want to, kind of frame it, process more compelling, then as a group leader, let's say, or fund manager, and we'll use those words somewhat, synonymously here, you can also build an infrastructure around the organization, which is a key element of being able to sustain and grow it and make it rewarding for all that are involved. So, in other words, in a typical group where people are writing individual checks, in the rare instances of having a hit, it will spin back to the individuals who are involved, but it won't necessarily benefit the organization, right? And most people who are not stock picking or startup picking in this case, which is even harder in an individual deal, let's say 1 out of 100, if the group's even seeing, attractive deals out of 100, which many are not, it's not going to have a, social contagion effect, right? Since we're running a fund, we have a carry like all funds do. Ours is lower than market, and that's by design. So it's a 5% carry for our annual fund. But nevertheless, there's some economic benefits, where we share in the proceeds and the success, of everybody that's in the group. The other, maybe more direct economic benefit to our organization is we've been able to grow the group exponentially. So, when I came in that 2016, era, there were like 60 people that were investors in the group and not all actively investing. Now there's over 300, and everybody in the group pays dues to the group, like many syndicates. If they are in the fund, they pay their carry to the fund, and we've now started to generate carry for the first vintage fund, which launched in 2018. So, it's more like a VC economic model than a nonprofit angel group, that, we still kind of have feet in, both sides of that world as we continue to also evolve as a group. And I think that process will, continue to, reconcile and crystallize over time. But the bottom line is it becomes something where hopefully you can see better deals and then also share in the benefits.
Yeah, that makes a lot of sense. Just without getting too much in the weeds of like the technical piece, I mean, is it structured as like a limited partnership, like a typical VC fund is? Like, how is it, and then like the carry goes to the organization as like the manager or the GP? How have you guys structured it from like a legal perspective?
Yeah, it's a multi-asset SPV that gets created every year. So it's a vintage or annual fund system. Let's just say 2024, 2025. The current vintage spans, 2 calendar years. We set up a LLC for each year. It's a multi-asset SPV, unlike an individual SPV where you have to, push and then circulate each deal, right? The capital gets pooled over a typically 6 to 8 week process when we have to stop fundraising because, again, we have more than 300 members of the group and the SEC cap is 249. So for the last 4 funds, not the first few funds when we were figuring it out and growing, but for the last 4 funds, we've hit the SEC cap within our group. of 249 members and around $6 million total to deploy over the course of that cycle. So that's how it's legally structured, and then it's managed by NuFund, the organization.
Yeah, thank you for sharing that. I mean, I think this is really interesting innovation because when you compare it to even like SPVs on Angel List, where sometimes it's like, 2% management fee, 20% carry, this seems like you're getting kind of this membership, you're building this community who will be more hands-on, I think, than most SPV investors, but the economics make a lot more sense and I think are more fair, while it still also aligns with the greater goals of the organization. Has this sort of new economic model around the venture group, does it change the return profile of the types of companies you're looking for? So like an angel investor would be happy with like a 3 to 5x return in 3 to 5 years versus a VC fund, they need to return 100x in 10 years. And so how does that affect the types of companies you invest in? And is there a difference between what you've done previously with like more, let's say a more traditional SPV or angel model and like a VC model?
There are a few differences, and we can talk about, kind of the current system, and then maybe Serhat can talk about some of our learnings, as we do a lot of data analytics now, and, where the puck may be headed, or at least some of the, irons will enter the fire, since, it's not really a monolith. And at this point, I think we're diversifying into multiple products as opposed to, one or two. But to answer your question, people ask me often, would NuFund like this deal? And let's just say we're talking about our annual fund, which is the majority of our capital and sort of, process. There actually is no NuFund that decides if the deal will be like. Remember, there's an invisible hand that does not have an investment committee. This is a divergence from a classic, VC, right? Or a classic angel list syndicate lead, right? The members vote democratically on whether or not we should fund a deal. So if you're one of the 249 people in NuFund 24, the current fund, then you have a proportional vote to whatever your investment is in that fund, right? It's not something that's selected by a centralized authority. So the appetite spectrum from some people who maybe like a classic, angel deal with the, lower maybe risk and lower return profile versus the moonshot, kind of hunters, are all in this same basket of investors. And the bottom line is, if 5 people want to write up a deal memo and push it to vote, then the crowd decides. And that's a very different model, obviously, from any, centrally managed fund. There are benefits and also there are downsides, to that model. And that's something we're grappling with right now, which Sarha can talk about. But that's how it runs today. And I think it's reflected in a very diverse portfolio if you look at the 120 or so investments we've invested in. And generally it's worked out well for us because we've done well in some, say, later stage medical device deals, when some of the earlier stage flavor of the moment tech deals we passed on, let's say, right? So there's a pretty wide portfolio there, but I think it's something that we also have to keep evaluating critically.
I mean, one thing I would like to add on to that is keep in mind that NuFund Venture Group is truly a pioneer in this sense. And as a former founder, when I look at NuFund Venture Group, I actually see a startup. And the startup that I see is a startup that had the beginnings of the product market fit. It is most likely at the seed stage, that has a beachhead market. And now the first annual fund model that we're talking about is more of a generalist model that depends on our totality of the group behaving in our current fund structure to decide what type of companies we would like to invest in. 90+% of the companies we end up investing in is venture fundable companies that are more in the seed stage, and they tend to be, in few different industries. But what we have understood, and now we're at the point of, increasing our toolbox and improving our product market fit, is the fact that different investors have different theses, different risk appetites, different desires for upside. So we are, our plan is to create more specialized fund models within our general model, so that we will have a group that will be more pre-seed and more, early on, ideally the very first check in an institutional manner, and then we can focus on building our seed to Series A model that exists, and maybe later on we can improve with secondaries and the Series A and B type of things that will come along. I mean, even though our system is decentralized, it might sound like it is like too disorganized. In fact, it is not. I think the administration and Ashok's leadership have driven a structure that is very workable for a fund for a company to be funded. You need only 5 fund members to determine that this is a good investment, participate in a due diligence process where at the end they will create a deal memo that goes to the fund membership that will within 48 to 76 hours decide if we would like to go ahead and invest in that company or not once there's a deal memo. And then when we look at it historically speaking, out of 125 deal memos, close to in the last 6-7 years we've done, 96% of the time the group decided what the ad hoc investment committee came up with, and the deal memo recommendation is within their expectations, and they go ahead and approve it. So it's not really a very decentralized in a sense that it is dysfunctional.
Yeah, and I would just clarify there that when Sarat says 96% of the deals got approved to fund, that's of the maybe 2% in totality that we've looked at. And here's the reason why, because you may be thinking, well, if any 5 people can just write up a deal and get it to this rubber stamp vote, then we'll be investing in everything when we're doing 15 deals a year, of $6 to $10 million, right, in aggregate. Here's where the maybe DNA of the angel group and the non kind of fund spirit comes into play, because in order for 5 people to write up a deal, one, it has to go through the process of review and evaluation and screening and due diligence by the totality of the crowd. 2, there's a trust and reputational bond there. Many of these people actually know each other, personally and professionally, because we do also have a lot of in-person, whether it's in San Diego, where the majority of our current in-person events and meetings happen, although they're all hybrid as well. But now in these cluster markets of Austin and Boston that we've launched, and we have others on the roadmap, you don't want to just write up any old deal and send it to get the guillotine, right? So the process leading up to a vote, which is very much based on the professional trust and respect within the group, that's the culture, right, makes it such that only serious and top shelf deals get a chance to get to the finish line.
Totally. I mean, in order for someone to go to the trouble of even writing the deal memo and getting 5 other people to support it, I mean, you have to have strong conviction in that company. So there is that hurdle. It acts as a really good filter. So I'm not surprised that that's actually the first barrier that kills a lot of the deals, is there's just not enough conviction from any individual investor. So I actually think that it's really interesting. There's a couple questions here in the chat. I mean, we could dive deeper in the venture group model. We should definitely talk about the portfolio success and support side of it. But let's get to a few questions here. So Ram is asking, what is the criteria that NuFund investors look for in investable startups, and what is NuFund's investment thesis? So maybe 1, are there specific types of companies you're looking for? And then 2, are there any benchmarks that you also look for?
Given everything we just talked about, where there is this NuFund kind of invisible hand, or maybe it's an invisible brain, we can't say that there is a single criteria. However, if we were to just distill down to 1, the majority of the deals that we've actually funded, and 2, the kind of deals that we're looking at now, we're looking for 100x type potential investments. So not really much different than your typical venture capital syndicate, and that's just the basic economics of running a fund, which is still very similar in our case to any fund model when we're talking about economics. And you asked me about that before, Ryan. So we are looking for outsized outcomes, knowing the rate of success for any startup investor. In terms of our specializations within those kind of venture grade deals, we tend to do more in deep tech. So a good portion of the NuFund composition comes from some of the biggest companies in San Diego. We're talking Qualcomm, we're talking Illumina, and then our remaining membership largely is represented by the other big tech and big life science companies, around the country. So we do have a deep tech specialization. I mentioned, I posted in the chat, we have another agentic AI demo day coming up where, we're looking at deals that's open to investors. We've already picked the deals, and we, do meetings like that on a recurring basis. But I think if we were to characterize the thesis within NuFund, it's really deep tech.
Yeah, that's really helpful. I love the idea of creating sort of like mini funds or mini specializations within New Fund because one, it might help you avoid that SEC cap, and then so you could grow your investor base. But then two, especially like San Diego, it's like life sciences, deep tech, defense, those areas are really hot right now. And so I really like what the vision is of this. There's another question here by Annabelle. She's asking, there's actually a couple questions in here. So, what's the ideal cap table structure for an early stage startup that's raising its first round of funding in terms of balancing a strong investment for VCs and angels while the founder also can retain control? So, what's like the ideal kind of dilution, I guess, in that kind of pre-seed to seed to Series A? And then the second part is, how much equity should that founder be willing to give up? So maybe we could talk a little bit about like the dilution aspect going from pre-seed to seed and then Series A.
I think what we look at is pretty similar to the general guidelines and benchmarks of the venture capital, landscape, which I think
C Carta or C Founders Institute. I mean,
yeah,
the answer is 15 to 20%, right, per those rounds. But I mean, that's pretty well established.
yeah. So, but if like there's established guidelines on there, but like 10, 15% before you go to the institutional, then 10 to 25% depending on how you do. But at the end of the day, by the time you're a founder, you come to Series A, you still would like to have at least 55 plus or somewhere around there equity left, so that you are in a fundable position for the future dilution.
And take a
Yeah,
lesson from Surhat. Just go to an angel group that doesn't treat you well, so you don't even want their money, and you'll retain more than the typical Carta benchmarks, which are, for the venture capital universe. Now, universe, you still have to succeed then with the company, which that's the hard part, right? But he kind of threaded the needle there.
Yeah.
yeah, I think that's really interesting. I mean, a lot of founders might think like, okay, VCs are trying to screw me and take most of my company. It's good VCs, it's actually the opposite. Like they want the founder to still have a lot of skin in the game going into that Series A, like you mentioned, sorry, at the 55%, because that's going to keep them motivated to perform. And so just back of the napkin math, Annabelle, is you should anticipate about 20% dilution. And then if you do a really good job, you have high traction and you could raise at better valuations, then maybe it's closer to like the 10 to 15% dilution in each round. But just if you're going to like project it out into like a standard case, I would use the 20% mark, and then hopefully you can do a little bit better than that. One other question here, and then let's dive into the portfolio side of things. Enviro 18, I think this is a founder. What is the period expected to receive an ROI when investing in early stage companies? Is it different for, an angel group like New Fund versus a VC fund?
We still go by the general benchmarks. So I think, the answer, if you take any venture report, is really in the 10-year-ish, kind of range. And that's the life cycle for most venture funds. Not surprisingly, some of them are often going to 11 or 12 years now because that's when the bigger outcomes often tend to happen if they're going to happen. So, I would just say and repeat what Sarat said, we're generally going by, the guidelines of the industry that we operate in. And I think the only difference here is there are people within the group and within the fund who may be happy to double their money in 2 years. And so we may see a small number of deals that fit that profile. And at the end of the day, no investor is, beating their head against the wall if they get their money back 2 times after 2 years. It's just that's not the way you can build a mathematical venture model, because it won't make up for the ones that are inevitably going to fail. And we can talk about, portfolio, both wins and losses. So even within NuFund, where there is this invisible brain, we're still not going to be looking for deals that profile to a 2x in 3 years. We're still going to be looking for big 10x to 100x type returns that might take 10 years to produce.
One caveat to that is I think with the venture group slightly different, is the fact that since venture group is driven by the member base, and when you have a member base like us, which has close to 353 members now, you have these different pockets of investors with different investment thesis. So even in the last 12 months, we have had cases where we have done collectively as a group, not necessarily through the venture fund, but the group working together, creating different SPVs or direct investments. Keep in mind, some of these members can write like larger checks too. We were able to fund companies that might not be as venture fundable in a true sense. They were companies that are, ideally will become a more private equity acquired type of company with less risk but less multiplier. Be able to utilize the group membership to raise even, I think one of those deals raised more than $4 million in the last year. But it was not a true venture fund type of company. But the fund didn't invest, but the members that got together, that understood the company, understood the subtle differences, was able to work together to achieve that. I think with the venture group model, you have a larger group of members that are trying to understand the founder and can sometimes crack harder to crack deals, either because of the industries that they come from, or the different type of signals and noise, or the very detailed, nuanced technical requirements. You have a better chance to be understood.
Yeah, and I think that's an important point, because you don't just have us here, Ryan, as emerging VC, micro VC X, that would say exactly look at the Carta data, for what's the dilution, or exactly look at, this, hot industry report from CB Insights if you want to know what we invest in. What Saurabh is saying is the bones of this organization here still allow for different types of investments beyond just the typical emerging manager, VC fund that, you'd be talking to or working alongside. And that for us then creates diversity. So we have a diversified portfolio that I talked about, but we also have a diversified financing portfolio. And we're continuing to build upon that, because at the end of the day, we want to be responsive to this, large collection of extraordinary members who want to deploy capital. Right? So then we have to build products that facilitate that. And some of them are existing and legacy products, and some of them are going to be new products. So it's not exactly like a buffet where, we'll invest in anything under the sun and through any means, but, it's more like maybe a Turkish breakfast. You can hear the accent of my friend over here, where, there's sweet stuff, there's some savory stuff, but at the end of the day, it's, still mostly eggs and bread, right? Like even, and, that's the venture, type deal that is the majority of investments we make.
I mean, as the Turkish American, I was supposed to be doing the Turkish analogies, but you'd really hit the target there. I know it's good to talk about some success stories and specific examples. Like one of my first dealings as a member with NuFund, and I think the first time I understood the magic behind this group was, there was a female founder that I got introduced that was building a digital identity solution that utilizes blockchain. And this deal came to me early in November, right before Thanksgiving. It was a hard deal, and I felt really, I really liked the founder. I really thought there was something there, but it was just too much for me to handle. And I utilized the group, and even though it was a blockchain model that at the time was a no-no for a lot of venture funds, the group came together, was able to, dissect the deal in a way that understood what was the core value proposition. And even before the end of the year, within 4 to 5 weeks, in a Thanksgiving time, we were able to close that deal that gave that female founder the chance to be able to actually complete the funding round that she was trying to finish, and she couldn't have a lead before. And now with us coming on board, she was able to conclude. So this venture group model, by being more, I think, harder working and a wider, diverse understanding and expertise, was able to do a deal like that. I think it would have been very hard for a small emerging fund to do, just because of the depth and the diversity of the experience.
And I think if you look at and you ask us, or what people say distinguishes our group, the most, it's the breadth and depth simultaneously of the membership, where we can see a deal that's next gen sequencing, or we can see a deal that's 5G wireless, or we can see a deal that's a B2B SaaS agentic AI, and we have multiple experts who ran units in companies that are doing that, or built companies themselves in those spaces, or they're just highly dialed into those spaces if they're emerging. And that's, I think, what really is our greatest strength. So we're just building operations around that asset base, right, to be able to successfully deploy capital into good investments. There's another Turkish proverb I'll share that I've heard from Serhat, and it's, if you have milk and you have sugar, let's make halwa. Halwa is a dessert. So our milk and sugar is that we have, these members that are exceptional, and we have capital, and the halwa is making good investments.
Yeah, I couldn't agree more with that depth and breadth. I mean, we do something similar with the Veteran Fund. I mean, we're limited to 99 LPs, but we're very strategic with who we brought on, who are subject matter experts in these various areas of like critical technologies. And it's just, it's amazing to see, like, one, like the investors want to be hands-on and want to be helpful, right? Like, they don't want to just put like blind capital to work. And so I do think like leveraging the collective network and experience is important. I think along those lines, like, what do you guys do? What's sort of the process post investment when the companies need support? Do you have like a specific like check-in, or do you have like a annual update, or is there like a Slack or communication channel where companies can put their asks? Like, how do you manage the portfolio and supporting them with that many members?
Well, it's multi-layered. I'm kind of on this meta layer where I'm dealing with all the companies, including, signing documents and, wiring funds. And therefore, generally, my role tends to be, okay, we're going to be raising a Series A. Can you make some introductions to some investors? And I do that. And, every few times a year, it lands in, $1 million check or $100,000 check. But then there's the more specific individual company role. And I'll defer to Serhat since, for example, I can think of a company based in Florida. It's a health tech, wearable that, he is constantly filling that role for. And there's others, and he can, share a few examples and specifically what role he plays.
Yeah, with our investment process, we have an ad hoc due diligence team. And oftentimes, one or two members play the role of a deal lead that ends up becoming, if there's a board observer seat, they usually take that seat, but they become the liaison of the group with that particular company. And they are, they get the investment updates. They become a way to look for ways to synergize our resources in a way that can help that company. If there are particular asks, they come to the group, use our internal Slack channel, so the Slack-like channels to ask for specific help from the group. So we do have that liaison person from our membership that is on the company side, and ideally stay with them. I mean, practically speaking, we know that we come early at this generally, late pre-seed, early seed stage. And we know that most of the time, the value that we can create for our portfolio companies happens in the first 24 to 30 months. Because if the company does a very good job, they usually graduate and they go to their Series A and other investors. Now we became a second or the third circle that they sometimes come to. But until that point, we are close in contact. And if we consider the fact that we have about right now 15 investments per year at any given time, are practically number of portfolio companies that we can help is about 35 to 40, which is not that hard to keep in touch with, given how many members and what type of connections we have on a regular basis.
Yeah, that's really interesting. I've got more of a personal question here. We have some aspiring aspiring investors who maybe are like thinking about getting into angel investing on this call. You know, Sarat, as a GP in a VC fund and as an angel investor and as an exited founder, like how do you think about your allocation to angel investing? Because like obviously you're skewed pretty heavily towards like tech investing and startups, which are like, essentially high cap stocks. How do you think about your personal investing strategy when it comes to that, and also balancing the fact that you're also a GP in a VC fund?
And I think I have to say, I do have another identity as an investor. After my exit, my relationship to early stage investing didn't necessarily start with angel investing. It started being an LP in VC funds. And I did that because I thought that was the best way that I not only can exposure to this asset class, but also can, be involved with helping, founders. And I did some LPing in several different emerging funds, which I quickly realized that even though, being an LP in an emerging fund is great, you have exposure to the asset class, and you do it in a very healthy way that you have diversification. You are not investing in one particular company. But then you are also one layer further away from the founders. I realized that my preference as an investor wasn't just the ROI that I expect from this asset class, but being able to be close to the founders, both from an intellectual curiosity, also paid forward mentality to help the founders. And I did realize that I could do that supporting the emerging managers. But let's face it, as emerging managers, now that I am a GP as a fund too, you want to use your LPs as a resource, but there's a limit to it, and they cannot really be part of all the investment decisions all the time or have direct, founder connections. So my GPing came from after my LPing, and I think it's a healthy exposure because I'm still diversified. I have more investment as an LP than a GP, and then my angel investor came almost as a gap filler, where when you're a GP or an LP to a fund, you are limited by investment thesis, and you cannot make investment decisions on a regular basis, and you're not as opportunistic and proactive. So I use still my angel investment exposure as a way to fill that gap, and maybe invest in startups and founders when there are enough signals for institutional investors to come in. But I do have this personal conviction in that founder that something might happen, and I have I have investments now where I invested as an angel investor first, then as a GP in CrossOcean, and then NuFund invested as a portfolio company, and even multiple times in different stages. So having these different tools really can give you not just more exposure, but can also help the journey of investment, both for the founder and as an investor yourself.
Yeah, that's a great overview. There's a question here in the chat. It really comes down to like deal flow, and just to tie it into your answer here, how do you think about like partnering with other funds? So, for example, as a source of deal flow, if another fund has invested in the company, is NuFund on their like speed dial list to like send the company over to NuFund? So, like, one, how do you source deal flow as the venture group model? And then the question here in the chat is like, how does someone, come to the attention, or how do they become top of funnel for NuFund?
Maybe I'll start and then I'll let you, Ashok, because that's a very critical, not only question, but also the difference when it comes to venture group. Because with the venture group, our entity structure is designed to have our stakeholder in the core, which our number one stakeholder is our investor group. But that doesn't mean that we're not founder focused, because for us to serve our stakeholder, number one stakeholder, our investor, we have to really serve our founders, because it's the founder that creates the value that helps us with the serving the investor. And because of that very purpose, since our stakeholder, number one stakeholder, are the investor, we are not primarily looking at, oh, we should have all our LPs and investors put all our money in our funds, or we should keep them in our group and try to put a barrier around them. On the contrary, we love having members that are VCs. We love having members that are family offices or high net worth individual angels that go and LP in other funds, because when we have more exposure and more deal flow partners, both upstream and downstream, then we can, I think, improve our deal flow and also can help support our company. So we are super open and enthusiastic, motivated to be able to work with with other investors. And I'm sure Ashok has some other things to add on that.
I would just, in summary, mission critical, the relationships with other investors, whether they're investors that are in the group, I'm talking professional investors, and we have many, whether it's investors that are sharing deals with us or whether it's investors that we're sharing deals with.
Yeah, that makes a lot of sense. Is there a in the last like 5 minutes here, right? There might be a couple other questions, so I'll do a last call for questions here. But what's one of the things that you found is maybe not working very well with the venture group model that you're actively working to change, or is there some friction point that you're working to continue to increase the value that you guys are creating as NuFund?
There's 100 things that we're working on constantly just to improve our organization, from the technology stack, to the culture, which, cultures like bonsai trees, right? You have to constantly, work on it. But I think the thing I'll dial in on here is, to quote not a Turkish scholar, but hip hop legend, going back to my roots, Jay-Z, the gift and the curse of this decentralized, democratized investment decision model that we have, and we talked about the gifts. The curse is that sometimes you have competing priorities, and sometimes you have loud voices that don't necessarily understand a space as much as a quiet voice. So the consensus driven model can work in some scenarios, but it can also be a blind spot in other scenarios. And I'll just say it's a problem that we're working to fix.
Yeah, very, very well said. And I think it also, early on, I said, as NuFund, we are pioneers, which also means that we have a lot of things to solve because we are at that seed stage startup level where we now know what's working, what can work better, and what we need to fix. And having more organized subgroups of investors with their own individual funds that have more organized and investment thesis with better designed decision-making processes will definitely help us perform better, because now I think we are not probably doing as many early founder bets as we want, because we are looking at a little bit more technology, a little bit more validation than probably is required to be able to do these higher moonshot early stage bets. And I think our success rate when it comes to failures is high, but I'm not saying that it's in a good way. I mean, when we look at our 115 investments in the last 7 years, we have maybe a couple dozen successes and failures that is already somewhat clear. But I think we should have had more failures than what we have now, which makes me believe that we didn't do as many tough bets, and that's something we're trying to fix by having a more a comprehensive toolbox.
Awesome. Well, there's I know we're wrapping up here. Just one quick question, Boris. I'm going to take your question in the chat. I'm going to kind of repurpose it a little bit. What's your tech stack look like? What are the tools that you guys are using? Is there anything that you found to work really well when either managing the group, managing the investments? Are there any approaches or tools that you found to be particularly helpful?
Yeah, well, I think, asynchronous, kind of, and, self-serve along with, sort of live stream, real time, tools as enablers. But let me introduce you to our CTO, Serhat, who I think can talk a little bit about, where it's headed right now and some of the things we've been building, both in stealth and then, deploying, because he's really been a visionary there, and not just a visionary, but an operator.
Again, thank you for that. Since we're pioneering in a place that is dynamically changing and also happens to be a small niche industry, as you can appreciate, we do not have established tech solutions out there we can easily implement to our use cases. So we have to use different types of um, tech stack layered on top of each other, and have to create custom integration solutions to maybe customize it to our use cases. And also the fact that, just like any other community-driven organization, we have super users, we have occasional users. So we have to have a tech stack that serves these different type of personas. So we have a Slack-like solution for super users that are using it on a daily basis, even multiple times, almost like a social media platform. Then we have solutions that are more learning platforms that is more demand on service on demand type. And then you are using CRM solutions that integrate and help us identify what's working, what's not working, how we can engage and onboard our members better. But by no means we are close to even saying that we have find the solution. It is very hard, I think, trying to do what we are doing, which is basically trying to create that third different type of investor class that is different than the angel investor and the venture fund model, which is not like we are not in the middle. We are not saying one is better than the other. It's just different. Maybe I'll leave it at that. If you're a founder today, what you're expecting from your investors. You're not expecting just capital. You're expecting responsiveness, conviction, strategy, customer partners. And if you're an investor, what you're expecting is to be involved, to learn, to back companies you believe in, to actually know what's going on after you write a check. So in that sense, the venture group model that we're building is trying to deliver results for those both sides, and without any type of tech stack. That will be a hard ask, and we're just trying to do to accomplish that.
Yeah, well, thank you for sharing that, and thank you to both for joining today. I mean, this was a really great session. I think the audience got a lot of value from it. So it's top of the hour. I think we got to end here, although I feel like we could keep talking. So, any final last words for the audience, Serhat or Ashok? Maybe what's the best way to learn more about NuFund and get involved?
So newfund.com is our website, and spoiler alert, we're relaunching the whole thing over the summer, along with a lot of the other, back end tools and infrastructure that Serhat just alluded to. But you can find us on LinkedIn. We definitely encourage connection, and we've met some great founders on LinkedIn. Just to take that one platform, some of our favorite members have connected with us through that platform. But we're generally, I would say, accessible people. I can appreciate the journey that both the founders as well as the investors, on this webinar are embarking on, and we're kind of all in that same boat together. It's a hard time, for venture, whichever side of the table that you're on, and also really appreciate you and Mike, Ryan, both from the Founders Institute perspective as well as the Veteran Fund, a institution here in San Diego that speaks to the culture, speaks to the mission, speaks to the spirit, and we're just very happy to be working with you as well.
Yeah, well, likewise, appreciate the partnership with NuFund and looking forward to doing some great things together. I'd also like to thank the audience. Thank you for joining us today. We'll send out the recording here in the next 24 hours. And again, if you're interested in learning more about NuFund, go to their website. And then if you're interested in learning more about the FI Venture Network, you can go to fi.co/venture. Thanks a lot, guys. Looking forward to the next one.